So rather than trying to go charge $100, $200 for some piece of content, make it a lead magnet for yourself. Go build something people actually want and give it away. And in exchange, have them help promote you, make them comment on your posts, make them do some action that gives you more visibility to people. So instead of paying for it, you're actually in turn trading it for exposure.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. I have a great episode this week where I'm chatting with an old friend of mine, Sam Silverman, who is one of the most successful capital raisers that I know of in the business, in the real estate industry. And Sam is somebody who I've known for a few years. We've collaborated on a few deals together. He's become a personal friend of mine. And in this episode, we dive into a few different topics, but specifically we start talking about the 2024 outlook, some of the things that he's seeing on the investor side, on the LP side, as it relates to what types of returns LPs are looking for, what types of asset classes that his investor base is interested in, how his investor base and its appetite has changed in 2024 as it relates to when he got into the business back in 2021, a few years ago. And we also talk about how new investors or new capital raisers can begin actually raising capital and building their investor list. And Sam shares all kinds of things he's learned over the last few years as he's gone from $0 raised to over $70 million in investor capital raised. I'll say that again. In the last 3 years, he's raised over $70 million. And 3 years ago, that number was zero. Just incredible growth, an insane trajectory. Somebody who is just playing at the top of their game and is really one of the go-to minds as it relates to raising investor capital. So he shares a lot of what he's learned over the last few years. He also talks about how an investor can go from $0 raised to seven figures outside of going to their friends and family. So how to actually build an outbound strategy to begin meeting investors and raising capital. And it's just a great conversation where we touch on multiple different topics, both from a current event standpoint and also just from an evergreen standpoint as it relates to how investors can raise capital more efficiently, more effectively, and actually scale their business from a capital standpoint. And Sam also at the end shares a little bit more about a community that he started in 2023 that has grown to over 100 members, 100 capital raisers in this community, all helping each other get better and more efficient at raising capital and ultimately raise more capital. So I think this is a great episode for everybody out there that's raising money. And if you're an LP, I would highly encourage you to listen to this episode as well, because we touch on a lot of conceptual topics as it relates to passively investing in real estate. So just a great episode. Really excited to release this one. And again, if you enjoyed the podcast, if you enjoyed this episode, please consider leaving the show a rating and review. Or if you're watching this on YouTube, please subscribe to the channel itself. Again, this is how we get this show in front of more folks, which is my ultimate goal, is to help more multifamily investors scale their business. And the more people that hear this podcast, the better. And again, reviews, subscriptions, etc., all of that helps. So thanks again for listening to the podcast, and I'll catch you guys on the next episode. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me again, I believe this is for the second time, is my boy Sam Silverman. Sam, I just gave you a little bit of an intro here pre-show, but why don't we start with your backstory out of your mouth in terms of maybe what you were doing pre-real estate, how you get into the game, and what your business looks like now.
Yeah, glad to be here. So like most people in real estate, I got here entirely accidentally. So when I first got out of college, I got into entry-level tech sales, which means you are pounding the phone, reaching out to people who have zero desire to go talk to you. So you get used to rejection really quickly. So from there, kind of worked my way up, did really well in roles like that, understanding buyer profiling, understanding how to go out and hunt for new business, started building teams that did the same function. So long story short, in the corporate world, spent a ton of time understanding how to book meetings and get in front of the right people when building out a profile of buyer. It applies really well to the capital raising side as well, which I'll touch on here shortly as well. So from there, started buying single family houses and realized it was not something I wanted to go do. It was really time consuming. It was really slow. And for me, being in a high level type day job, especially in the sales world, where in sales, if you perform well, you can make 3-4x what you should. If you don't perform well, you'll make half of what you should and be a quarter away from being fired. So on my end, I'm like, okay, my time's better spent working in my day job. Sold off all my houses that I had. I think I had 9 or 10 houses at the time. Started investing as an LP into larger projects with people I, found through podcasts like this, and probably got into 20 or so deals, and as an LP, a variety of asset classes. From there, realized there's two primary things that matter that actually get you equity in projects, right? One is you find deals. That wasn't for me. Two is you find capital. That made a lot more sense to me when thinking of my background as to how do I go build that investor profile and reach them at scale, which is what I've done for years in the tech world. So fast forward to where we are today. Now I probably raised close to $70 million by the end of this month. I'll probably hit some 70 million over a variety of asset classes in the last, a little under 3 years. So have really spent a ton of focus on capital allocation. So finding great partners, different asset classes, and I've worked with you in the past as well here. And really now just focus on how do I get really good at raising capital, and now how do I go share that with people as well who want to go learn how to do the same thing.
Yeah, love it. And again, we've had this conversation on the show before where we spent a lot of time talking about how you got your business kind of off the ground, a lot of the early steps you took to raise those first chunks of capital as you were transitioning from buying the single family home, selling them off, and then raising capital for other people's deals. I'm going to link that episode in the show notes for everybody that hasn't heard it. I believe it was roughly 18 months ago, a couple years or so ago now, but we touch on that. We dive into that quite significantly in that episode. So my objective in this one is to talk about some current event stuff. We will get into tactical capital raising tips at some point in this episode, probably the second half. But again, I wanted to plug the first episode that you had on the podcast. Now, quick comparison point. You started scaling, at least in terms of what I remember, and correct me if my timeline's a little off here, but really in 2021 is where you started to raise a lot of capital, right? Where you kind of transitioned away from, got the family and friends network, and then you really started to tap out, friends of friends, friends of the professional network, some outbound prospecting on LinkedIn. Maybe we could touch on that. And you were really starting to raise meaningful amounts of capital for other operators. That market environment is completely different than the market environment we're in right now. And we're recording this early January of 2024, just right after the turn of the new year. This is going to go live in January. And from a 2024 outlook standpoint, kind of state of the market, I'd like you to just riff on maybe what's different from, call it 3 years ago when capital was abundant. Everybody was chasing deals, self-storage was hot, multifamily was hot, mobile home parks are hot, right? Versus what's going on now in terms of the investors you're speaking with and maybe some of the changes in what they're expecting from a return standpoint, maybe desire to be in different asset classes. So very broad question for you, but maybe touch on some of the differences you're having or different conversations you're having with investors now comparatively to then.
Sure. So one thing I definitely touch on is that every dollar you raise in 2023 is probably the equivalent of $2 to $3 in a more normal, stable year, right? It was dramatically more tough to raise capital last year than it was in previous years, right? So I think that's a big piece of it there, is that deals are harder to get done. The irony of it is there's way more deals out there right now as well versus what there has been in previous years that make more sense. So I think from the investor standpoint, deals right now, assuming you don't have that, sunk cost fallacy at times for deals that you were in previously and have the emotional tie to it, right? You may have less capital now, you may have less, net worth that you feel like because of home price or whatever it may be. So people right now, I'm actually seeing that the deals, they have the liquidity for it on a risk-adjusted basis, they're far better than they have been. And what I mean by that is, like, take a multifamily deal that you're seeing, traditional Class B value add type project, 80s, 90s, 2000s type build, think 100 units plus in that. Most of these deals model to anywhere between a 14 and 16 IRR net to investors over a 5-year period, so roughly 1.92x multiple. And you're seeing a similar return profile that you have in previous years in terms of their model. The big difference now is that these deals are fixed rate debt and lower leverage, meaning the likelihood of actually hitting that return is far higher, right? So I think your risk-adjusted return is actually greater than it has been in the past. you just won't have those. People got spoiled with a period of time in which you can go buy a deal at a whatever cap rate it was, and now the cap rate is 80% of what it was before when you're going to sell it a year, 18 months later, and you could have messed the entire deal up and still hit 1.5, 2x your investors in a 12 to 18 month period, right? Like you can mess a lot of things up if multiples of properties are going up that much. So to answer your question, I think right now people are really focused on one, liquidity personally, right? Like there's a lot of turbulence in the macro environment right now, right? It's an election year. We have wars going on in the country. We have a lot of things out of our control that we can't really impact. So I think right now people are really holding on tighter to their capital from a place of stability versus looking at how can I go make the most of my money every second. So I think that's something to have in the back of your head when you talk to investors, is that being in a place of financial stability and personally may matter more to them right now than it has in the past. So I think that's one thing to really consider. Second, a lot of them are concerned with, how do you not lose my money, more so than how do I go maximize my return? People like the feeling of safety and stability right now more than they care about eking out a few extra percent. Also, you're not competing with the risk-free rate of capital when looking at risk-free returns, when looking at the bonds, when looking at high yield savings accounts, right? I know there's accounts that have 5.25% right now. So most deals, especially value add type deals, maybe hit that the first year, give or take, in terms of yield. So a lot of it's you're betting on the upside. So what you're seeing is the cost of capital has different perception now than it has in the past, right? Just because of what's going on. So on our end, kind of where we're focusing right now is debt that's fixed, right? We're okay giving up some upside if we can sell it sooner and paying penalties and doing so to make sure we're in a place of stability. Like, for example, I run a fund for Airbnbs, right? Short-term rentals, and almost all of our debt is fixed for 30 years, right? 30-year P&I debt. And the reason we're doing that is that actually the spread from P&I to IO debt has widened. So you're roughly the same amount payment-wise too. And our biggest downside is that, hey, we can't sell in our 5-year period. We have to hang on for 7, 8 years. So we actually go pay down more of the principal balance. It de-risks us in that sense as well. But we want to make sure that we will have fixed rate debt that we know what we're paying into. We know our debt service coverage going into it. So we have that buffer room for things to go wrong and not to do capital calls, not put investor principal at risk. So stability there is really important for us. We also feel as though we're early when we look at the markets. Right? We've seen compression in almost every asset class the last handful of years, where we feel like we're still early before institutional capital has flown in there. Second, we're still bullish on some parts multifamily. Right? Those deals have to have a story to them. Distressed seller, bad debt, something, right? There needs to be a story to why this deal is getting done. Right now, a lot of it is bridge debt that's coming due, right? A lot of 3-year terms from 2021, right? Q4, Q3 of 21 are coming due soon. I think we'll see a lot of those deals go up for sale to go try and preserve semester capital and then return some capital versus losing all of it to the bank in the future. And third, we're really bullish on mobile home parks right now as well, right? When you look at the longevity of those plays, those are deals that we'll buy and never plan to go sell. So for us, it's a huge depreciation play, right? Investors, the same thing as well, especially they qualify for REP status. And there it becomes a land lease play, right? They're not making many more mobile home parks due to NIMBY laws, not my backyard, right? There's better use of the land potentially in the future to get bought out. But you also just you're leasing a piece of land and it's very low OPEX, very low cost. So I think in any kind of environment, they should fare well. And finally, lastly, we're pretty heavy in debt for now as well for investors because it provides a level of liquidity. So slightly above, money market account returns, thinking that 8% range overall, but provides a level of stability and liquidity to investors who may want safekeeping for their capital in big chunks, but they don't want to go lock it up for a 5-10 year window because they may need it. They may have opportunities elsewhere. So long answer to your question, but hopefully that gives some context.
Yeah, well, it was a very broad, vague question, right? So I kind of set you up to have to go for a while there. But one component of what you just mentioned that I want to focus on specifically, because I think it's maybe the most easily interpreted by a lot of the folks listening, which is, for lack of a better way to put it, like, what types of returns do I need to be underwriting to, which is incredibly vague, right? But you mentioned in 21, 22, like 14 to 16% projected returns were relatively the norm. I have all of my own opinions as it relates to like people were investing in
Yeah.
heavy value add Class C deals and Class A deals with the same projected returns. That didn't make any sense at the time. I think now a lot of the LPs that were participating back at that time have a little bit more savviness or more aware of the different types of deals that maybe align better with their own objectives, or a better sense of how to kind of spot challenges as it relates to execution risk and the actual class of a deal.
Yeah.
Yeah.
You need to be compensated accordingly for the risk you're taking on as an investor, right? So like if you're getting involved in a development deal, for example, the highest risk, the most moving pieces there, right? Zero cash flow from day one. If you do certain parts of the process that are no cash flow periods, right? You need to be compensated the highest for taking on the highest level of risk. So to me, development should start with a 2 when looking at a return, right? When looking at the IRR projection for a deal, it should start with a 2. And then it's a sliding scale down, right? The heavier the value add, right? The heavier the risk in that project, you should be compensated for it, because the heavier the risk means your floor is therefore lower as well, right? So like when you look at these deals, the more you're getting, Class A, Class B, like it kind of just slide down. But a Class A stabilized deal, you know what you're getting into, right? It's built in 2022, a 300 unit deal in a major metro market, right? Like it's pretty freaking stable. But you can only add so much value to a project like that. Therefore, your upside's limited, but your downside's also more limited as well, right? When you get into these deals that are older, heavier value add, bigger lifts, your upside goes up and then your downside goes down further as well. So I think each deal you're looking at should have a commensurate floor and ceiling relative to the type of deal and lift that it is.
Mm-hmm. Yeah, and it's interesting because I don't think that was really the case if we're going to talk about 2021, for example, where capital was just chasing opportunities, and it was just you could invest in a 14 IRR projected Class A new build or one that a 17 IRR Class C heavy value add, and I think a lot of investors were chasing numerical returns from a projected standpoint that didn't necessarily align with the risk in investing in those deals. Would you agree that maybe that perception has changed and that's much more of a focus of conversation now as it relates to, hey, this IRR is nice, but now we're going to get to the second order of thinking here and start analyzing what's actually going on behind the scenes, whether that's market, product type, et cetera? Or do you still feel like a lot of LPs are just looking at projected returns, and investors should still align maybe what they're trying to, I should say, active operators align what they're looking to buy with maybe what LPs would want to see?
I think there's a big group of people as well doing deals that artificially inflate projected returns to attract capital to them. And like there's some deals I'll see, because I'm on probably 200 email lists of people. I run a community of 100 different capital raisers as well, and I see a ton of deal flow. And there are people who post deals starting with a 3, right? 30% plus IRRs in them. And it's nonsense, right? Like it's legitimate nonsense. And you see those things, and like I won't even take the time to review a deal if it shows that high. For the reason that it just something's off there, right? Like you don't want to go have returns that are so astronomical that you burn all your buffer room in doing so. Like when you look at a deal and say it's a 6 cap on exit, if you move it to a 5 cap or a 4.5 cap, those numbers jump up dramatically return profile wise. So if you're an investor and you're solely looking at the number in terms of return profile, like go look more deeply into what you're looking at. I think people's perceptions may have shifted on their second or third capital call they've received in the last while, right? Or when you're looking at deals from that lens. So as an investor, like really dig in, understand what are these key assumptions that are driving this return? What's the execution risk in terms of the actual project itself, but also the operators too, right? Like when you look at the fee structures in deals, the compensation for deals as well, if someone's done this 100 times, they should be paid more than someone's done it twice. The reason that your execution risk goes down each time of doing so. They have a larger team, more people in place, more buffer for things to go wrong and situations they've already run into that isn't a first time figured out type piece. So all those things need to go be a factor as to how you evaluate a deal as an investor. Is the, one, like the execution risk of the deal, 2, what's the actual lift of the project, 3, the operator's experience in doing the exact same type of deal, and just like what, the assumptions they have as well that get them to those return metrics.
Yeah, no, 100%. All right. So shifting gears here a little bit in terms of talking about tactical capital raising tips for folks out there listening, whether they're active operators looking to raise dough, whether they're folks who are potentially looking to capital raise for other individuals. In 2024, right? I don't know if the landscape has changed as it relates to what your approach would be to raising that first, call it seven figures, first $1 million compared to a couple years ago, because I know we touched on this when you were last on, but I'm going to ask you anyways, right? For folks out there that are new to raising capital, and I'm going to actually provide a little twist to this question because I think it'll make it a little bit more tactical for folks listening. Family and friends aside, right? We can all call up our family and our very close network and tap that out. Let's say we've tapped those folks out for money. Where do we start as it relates to raising our first $1 million from people that don't know us?
So that's actually how I started myself. Like my friends and family that invested with me, they've had to go personally ask me and, multiple times to go invest with me. Right. But the reason that if you're getting into it, someone close to you, they need to be really conscious of what they're doing is that can impact relationships positively and negatively. So right now I do the exact same thing looking at going to start raising capital again, right? I view it as a 5-step process and I can kind of explain it how it relates to myself as an example. So one, it's really understanding who's that avatar of investor that you want to connect with. If you say a high net worth individual, you have a lot of work to go do, right? Like the more niche you go, the better you'll be. People feel as though if they go too niche, they can't speak to their group. It's not big enough. Like I've raised roughly $70 million in the last, 2.75 years from 260 investors. People have actually written me a check. So like you can go niche and still do very well. For me, for example, I only focus on people who are high level sellers in tech or software or senior sales leadership roles in tech or software. The reason why, kind of second step is understanding like, what's that connection you have with these people? For me, I was in that role previously. I can speak their language, have a peer-to-peer conversation, understand that, in sales, for example, you're 1/4 away from a 6-figure commission check. You're 1/4 away from being fired for performance, right? Third, it's understanding, okay, how do you get in front of these people at scale? And for me, it was LinkedIn Sales Navigator. If you are in sales in tech and your LinkedIn message dings, you run to go see what it is. Because for them, they likely know that it's a prospect or something. So you understand that your visibility of viewing is very, very high. So you can get in front of them at scale. Like you can go build a list on Sales Navigator of people in senior leadership roles in tech, sort by tenure as well, if they've been there for a certain amount of years. That way I know that if they've been in sales for 6 years, right, 6 years plus, they're likely making 200 grand a year or more. So for them, I could carve a list really easily of hundreds of thousands of people. Then next, it's looking, okay, how do I get in front of them at scale and book meetings? So you get roughly 150 connection requests per week, give or take, depending how you use them, to go build people into your network, right? Adding them to LinkedIn, starting conversations. From there, once they actually accept you, you can go start, running campaigns towards them in terms of messaging, add them to your company profile on LinkedIn, also free, right? Like Silverman Capital, free profile I built. I can go add people every month to it. Really easy saying, hey, Axel, thanks for following Silverman Capital. You may not even realize you probably just clicked yes on your connections and clicked yes to it, right? But you subconsciously realize, okay, I accept this now. Let me hear them out for a second, right? So it's writing articles to kind of fit that profile as well. But really, it's just getting in front of them at scale, reaching out to them. And then lastly, understanding how to go run an investor call. I think a lot of that ties to the educational side of it too. If they're kind of newer investors, understanding how to go position what you do, right? I think that's where that common connection piece comes into play quite a bit. But again, I do it really similarly as getting in front of the right people at scale and really digging deep into one key persona to start out with. You can always branch out into more of those. Like for now, for example, I have investors who are athletes, lawyers, doctors, surgeons, right? These are people I met organically or through referrals. I only focus on that one profile person because I knew that if I get them, I can have a very good conversation with them and that they also have money to go invest. The worst that you can go do is target a profile person that makes 100 grand a year. And nothing wrong with that career, but think about it, making 100K a year, you're taking home 70 after your 401k and taxes, maybe a little bit less even, and you have to go live. So that person maybe has $10,000, $20,000 a year to go invest, if that. Right. So even if you get that person, they're interested, there's not much there.
Mm-hmm. Yeah, exactly. So, I think a lot of investors have a sense of how they get people on the phone, right? Whether it's using a strategy similar to what you just described, or whether they're just like literally manually, I don't know, reaching out to everybody that they physically know, or they're a dentist and they're going to a dental conference and they're setting up a booth and gathering all of these leads. But I think where a lot of people fall short, and I've had this challenge in the past, is they're only raising for a couple deals a year, maybe, right? Maybe they're doing 2 deals a year, 3 deals a year. And there's all this time that passes from when they meet someone and from when they actually have a deal to go out there and actively raise for, and therefore to have real conversations with these investors and actually have something to present to them. So what are you doing in the interim to kind of keep these people warm, to keep them interested, to nurture them? Are you doing email lists? Are you doing other stuff? How
So
do you keep people kind of in
it's
the sphere?
yeah, it's a bit different for myself versus someone like you, right? Because for you, you're likely only raising capital for your own deals. So it's
Mhm.
basically you have to go find the deal to have capital to go raise for it. On my end, I've got a handful of partners I work with programmatically in their projects that we have a ton of deal flow. I also have two funds that are regularly open year round. So I think as the operator, right, if you're actually doing deals consistently, the fund route is great to go because you have that fund take a piece of each of your deals, right, as you raise capital into it. But always having an open offering for investors is huge, right? That downtime will kill you because most people, if they're going to go invest money, it's burning a hole in their pocket, right? If they're not giving to you, it's going to go to someone else. So having an open offering at all times is really helpful. But to answer your question more thoroughly, when looking at how do you communicate with them, for me, I've been lucky in the sense that we've probably done more than a deal a month since I've started raising capital between different types of projects. So we've always been really engaged from deal flow being pushed out. The newsletter is a great option, right? Monthly, weekly, really good option to go share. The newsletter is a great piece because it helps them understand how you think, right? The more they can understand who you are and how they think is huge. Like you on your podcast, someone else thinking about investing with you, go listen to my 300 episodes of my show, hear what I'm saying each week. You'll get a really clear idea of, am I someone you want to get to know more to see if you want to invest with me, right? And they have that conversation with you. It's a lot warmer of a call, right? Like people feel like they know you already. So your job in those, newsletters or podcasts or content that you're writing for them is helping get a really good understanding of who you are and how you think, because it'll do two things. Either they'll like you, they won't. Either is fine, but they'll have an opinion of you at least, right? Like if you say Grant Cardone, everyone's got an opinion of Grant Cardone, right? Whether good or bad. Not saying either is right or wrong, but because of that opinion, the people who are where it's good, they'll likely go support him. Bad, no difference, doesn't really change anything. So newsletters are great. Getting on podcasts like this is great to go tell your story. Content creation is huge as well, right? Like writing articles that apply to your persona of investor, right? If you're targeting, dentists, you can do an article on, hey, how dentists avoid carpal tunnel syndrome by investing passively, right? Because you're using tiny tools to do this. So you can do things like that to kind of stay in front of them. But deal flow is huge. So if you're an operator, the fund structure of having those funds take a piece in your deal is hugely valuable to have an open offering. But keeping deal flow open is definitely a really big piece of this as well.
Yep. No, without a doubt. I mean, that's the challenge of being an operator and raising money for your own deals, fundamentally speaking, is that's a constant battle that you face unless you're getting to the scale from a deal flow standpoint to where you're consistently raising for your own deals, which is a lot of work to get there. And that takes years to develop that type of deal flow to consistently be doing that type of volume.
And you can always go partner as well too. Like if you're an operator in deals in Florida, New Hampshire, right? But you may, if your deal flow slows down or you have excess capital to go deploy, you can always partner with other operators in different markets to go provide your investors diversity as well and keep your deal flow going. So big piece of that too is like, if investors got $1 to go invest and you only bring them deals in New Hampshire that are, class C value add type deals, you may get 25, 50 cents. But if you don't go collect that full dollar, we have to go bring them other opportunities as well. So that balance could be a really good piece of it too.
Yeah, without a doubt. And yeah, it's an interesting battle when you're on that side of the table. When I say that side of the table, I mean someone who's operating deals and doing everything soup to nuts as it relates to finding deals, raising the dough, and then operating, right? Because you're balancing multiple different roles, responsibilities, and trying to prioritize your time across those different components. And if you're going out there and raising for other people's deals and you have that deal flow, right, which is great. I think that begs another question, right, which is having a lot of deal flow is great because you have a lot of opportunities to send investors who learn about you and get on the phone with you and they have a couple bucks. You have things to send them to, but then you're on the other side of the table. You're trying to balance
Forecasting.
commitments to operators
Yeah.
with maybe not the full complete understanding of what you can actually raise. And now you have a great sense, right? You're doing this at a real scale, right? And that's probably less of a concern than it was a couple of years ago. But let's actually rewind a couple of years ago and put yourself in that position where deal flow is scaling.
Even now you're guessing, right? Like,
yeah,
I've done this 40 plus times. And even now you're still guessing as to what comes in. I think it's actually harder now than it was 2 years ago to go forecast, right? In terms of, I think I know my investor base better than I did previously, but you also, like, the macro environment just changes things, right? Like,
yeah,
the period of time from when someone says yes to actually giving you cash, like right now, a lot more can happen in that window where people feel less comfortable to actually go allocate that capital and remove from their account into yours. So I think it's really tough to go solve. And I talk to people regularly who have raised a lot more capital than I have, and they still have a tough time forecasting it. And I think the biggest thing you can go do as a capital allocator in that position is, like, think of it as a sales team, right? And they have to go get to a number. And if you're going to come up short, communicate early and often. What people don't want to have happen is you hide it out of embarrassment or out of fear of them being mad at you. Right. The only time I think someone actually gets mad at you is if you tell them 2 days prior that you're going to be short a giant chunk of capital that puts their money at risk and their other investors at risk in that deal. So, like, no one's got this totally solved to the short of it. So just over communicate when you know something is off, or kind of just where you're at, and regularly forecast things as well.
Yeah. Yeah. I mean, it's I think a constant battle, especially now, as you mentioned, right? Because now you're contending with macroeconomic headwinds versus 2021, where it's like, who do I know that wants to give me money, right? It was a much more simplified process because if you had a project that made reasonable sense with a decent team, you're removing a lot of the hurdles as it relates to somebody writing a check. Whereas now there's a lot more. Do you do anything else other than just maintain deal flow to kind of pulse the list, to kind of develop a sense of what's out there as it relates to what you can raise at any given time, surveys, stuff like that? Or is it just, we're taking deals out, we're raising dough, we're going to see how much we get?
Yeah, I'd say it's more the latter. We've done surveys in the past as to kind of what deals people would want to go see, right? In terms of kind of where we can go focus, because as an allocator, the benefit of, if they want to go see a certain type of deal, you can go do your homework and go find a partner that aligns to that in terms of bringing them something that fits that. So, and the biggest thing we saw recently was that people want options with liquidity, right? The liquidity play becomes huge for them, as it's a lot less emotional having your capital that you can go get it back. The tied up piece of it, I think, evokes a lot more emotion and also financial stress if you actually need that money for life events, right? So, but yeah, we're still, anyone telling you they're not totally guessing is full of it.
Yeah, no, I hear you.
Your range can get tighter, right? But you're still within a range always.
Yep, 100%. All right, so you've been in this for a few years now. You've raised a lot of money. What are a few lessons you've learned maybe over the last 2.5, 2 3/4, 3 years that really like stick out as, like, when I'm thinking about what I've learned or mistakes I've made that I would not do if I were to go do all of this over again? Are there a few that jump out a little bit more significantly?
I can think of a few. So go slow to go fast, right? I think right now, when looking at raising money, the dynamic has shifted from operators to capital raisers, in the sense that there are far more deals available than there have been. And the capital is far more needed than it ever has been in the past, because you need, one, more capital for a deal, and two, there's less capital out there. So the dynamic has shifted to a power balance where capital raisers have the leverage in the scenario. So you have to work with the first person who wants to go raise capital for their deals. It's not some honor, right? Like, people view it as, I look at my LinkedIn inbox, my VA manages it, but we'll see these conversations of, so-and-so has to raise capital for them. And they feel like it's some giant badge of honor, which it's great. They reached out to you. They likely view you as a competent person to go do that. Awesome. But because they asked you, it's not some, like, you didn't accomplish anything yet. So really take your time and do your homework on who you're partnering with, right? There are deals I've done when I first started out that I likely would have avoided doing if I knew what I knew now in terms of who the people were, and also deal structure too, right? So I think understanding the whole capital stack in a deal is crucial. For example, one of the first deals I ever did had a giant piece of pref equity in it, which pref equity can be a great tool. What it typically is you have your senior loan, you have your pref equity, and you have your LP equity behind that in terms of how it gets paid out. And pref equity typically costs less overall than LP capital when looking at a return. The benefit there is that if the deal overperforms above that hurdle, the LPs make more. The downside is that if it performs below that hurdle, the pref equity gets paid first and gets their capital back first in this if there's ever lost capital as well. So it can be a great tool if used the right way. So understanding how it's used, how much the capital stack pref equity sits is really important to go do. When I was first starting out, that was not something I fully understood, and definitely have deals that were structured in that way that I wouldn't do going forward because of that. So understanding the who of who you're partnering with and also the how of how the deal is structured are two really, really important things going forward.
Yeah, 100%. I mean, we learn those lessons in tandem, I think. I think that like it's very easy when you're early and you're raising money, whether it's for you have an opportunity that you may have found if you're going to be someone who's going out there buying a deal and operating it, or if you're looking to raise for somebody else, to get overly emotionally excited about the entire process and to kind of lose the forest for the trees. And you forget oftentimes that like, yeah, we still need to do some diligence here, despite the fact that somebody is interested in bringing us into their deal. That's also a signal in and of itself a lot of the times, right? And
something too, like on my end, like I would have paid a lot of money to be able to go at people that I can go connect with and avoid those mistakes, right? Like that mistake, I think I raised close to $1 million for that deal. And in a normal deal, you should probably make between low end 80, high end about 150 for raising that kind of money. That deal, I'll likely make zero. It's also probably about 1.5% of the capital I've raised in total. That takes up probably about 20% of my headspace and work going forward now. So it's not only that my hourly rate in that is probably negative, and second, you're putting your investors at risk in doing so. So I think having people around you who you can go to and connect with that have been there and done that, like paying to avoid those mistakes, will pay you back in spades going forward as well.
Yep, 100%. And I mean, it's a challenge for a lot of folks because it's hard to, when you're starting to raise money, it's hard to find the operators that are also willing to give you an allocation in their deal or commit to bringing you in for a chunk of cash, call it 500 grand, right? Because they don't know that you can perform, right? So they're not incentivized to bring you into their deal. So it's really hard in the beginning to get over that hurdle, which oftentimes is, the first one obviously is important because you want to set the right expectation for your investors. Obviously, you don't want to miss. You want to make a couple bucks yourself, but in order to do so, right, you may need to give up some of the economics to the operator as it relates to, hey, you're very experienced. I know that you have a multitude of options as it relates to investors that want to raise capital for your deals. I'm willing to take, I don't know, less of however the deal is structured and however you're being compensated as a capital raiser, whether it's a fund of funds or a co-GP. Talk about that in a million different episodes. We don't have to do that now. In order for you to actually earn the right to enter the club, so to speak, because I think it's really challenging to find that operator in the beginning that's willing to bring you in as a capital raiser or a partner.
And something as well is like your first deal, you be okay making less in the short term to make much more in the long term. And when I say that, it's the whatever fees you're taking in the deal and how it's structured. We can get into the logistics of it at a different time, but I'd work with better people and make less with better people than potentially make more with people that provide a lot more risk, like the scenario we were talking about beforehand. So that's a big piece of it too, is understanding what does it actually look like for me and my investors if things go wrong, right? And like the bigger the groups you work with, because it's a tough balance, like these bigger groups that are more programmatic in how they operate are tougher to get in with at times. These smaller groups may have more upside to them in terms of how they're structuring things, or the deals are at a better basis because they're smaller, right? But you also have execution risk then. So I think it's a balance of finding groups that have been there and done that, but not too senior where they won't entertain you at all. So again, partnering with other capital raisers as well to bring a larger allocation always helps your negotiating power as well by getting in with larger groups and better communities. But yeah, it's definitely a tough balance to go strike there.
Yeah, I mean, I think it's just being aware that that's a dynamic as you go out there and do it. I think is really just the important thing, and understanding that that is, hey, you're going to be on a spectrum here, right? You shouldn't go too far to either end, because if you go too far to the end of I want to work with an extraordinarily experienced operational team, they don't need you, right? They already have the capital either themselves that they can raise, or they can go work with other people, and it may just be hard to develop that relationship. And then obviously on the other end of the spectrum, being someone that has no access to capital and needs you. If you find somewhere in the middle and then you start working your way to the end that you want to be at, it gets a little bit easier. And the reality too is like there's just not a lot of great operators. Like the longer I'm in this business personally, the more I realize like most operators are just the same, and it's a very small percentage that are actually very good. And I'll define very good as they're earning outsized returns relative to what folks that are employing their strategy earn in the same market. And usually that's because of vertical integration. It's because of unbelievable vendor relationships, length of time in the marketplace, better deal flow. And I think that list as a percentage of the overall folks you can raise capital for gets smaller, at least for me over time.
And not a high one.
No, it's not high. It's not even the 80-20 rule. It's like a 90-10 rule or whatever it would be, right? Where it's like 10% of the operators are earning 90% of the above market returns. And I say above market being like, if a monkey were to buy a deal and run it with an okay PM, what's the return? Above that, the 90% are being earned by the 10% of operators. And it takes time to get a seat at those tables, I guess, long story short. So to round this out, I mean, because I want to talk about, again, maybe you mentioned the strategy you would use to raise that first $1 million outbound LinkedIn prospecting is something that you would still do now. Is there anything else that you would add to that process early on as you were starting to get off the ground, right? As you were starting to raise that first million, that first $5, that first $10 million, that you would go and add to your process or add to your strategy as it relates to maybe accelerate that path? So if you were starting over now.
Yeah, I think there's a few different tools you can go use as well, right? Like the two big ones are conferences and podcasts. And I have really, conflicting views on them. When you look at going to a conference, if you're going to a real estate conference to go find LPs, one, don't. Two, go to a conference. So say your target is my target, right? Say you're targeting people in tech sales. Go find a tech sales conference where people that fit your profile are actually going to, right? Go figure out how to be the one of one, right? You're the real estate person, the real estate guy or girl who's going to one of these conferences where you can go stand out and make a difference versus being the person looking for capital in a sea of operators, right? Who are also looking for capital for their own deals. Second, when looking at podcasts, like for me, this podcast is not to go find net new investors anyway, right? This is much more so a credibility play, right? People can go hear how you think, how you operate. Maybe I'll find one investor comes out of here, just listens to it, likes what I'm saying, interested in what we're doing. But it's much more so exposure for how you think and how you operate. For someone who's already talked to you or on the fence of talking to you, they search your name, this comes up, they can hear how I think and operate. Maybe they like it, maybe they don't like it. Totally fine. But it's important to understand if you're going to be one of the many real estate people or many people in your asset class that you're talking to, it's not a place to go attract capital typically. So finding places that you can be surrounded by your people. Like for example, if you're targeting dentists, like go build a Facebook group, right? Go provide education there. I think figuring out something that's worked really well recently for me as well, for my community is offering free content giveaways on places like LinkedIn or Facebook, having people comment on them. If you can look at my LinkedIn posts, I've had two go somewhat viral the last, month or so, right? And you're giving away something free. So rather than trying to go charge, $100, $200 for some piece of content, make it a lead magnet for yourself, right? Go build something people actually want and give it away. And in exchange, have them help promote you, right? Make them comment on your posts, make them, do some action that gives you more visibility to people. So instead of paying for it, you're actually in turn trading it for exposure. So figure out something that people who fit your avatar would want. go spend the time building it out and you can use it forever. Like writing content is not the easiest thing to go do for me. It takes me a while, a lot of energy to go do it. But once it's done, you can use that forever. I have an article I wrote 2.5 years ago. I still share today because it holds value and tells that same story still. That article's probably raised me $3 or $4 million from that one article on LinkedIn and Facebook that I've shared it, right? It probably took me 5 hours to go write. So all to say is like figure out a place you can go be one of one when looking at the real estate person and figure out content you can share and give away that people are actually interested in, that they'll promote you for doing so rather than charging some kind of fee for it.
Yeah, I could probably do a whole solo podcast episode. Maybe I will, about how I just don't see the point in a lot of real estate conferences if you're trying to raise capital. If you want to learn the game and you want to go meet other people that you could potentially
100%.
JV with as an operator, like that's not the place to go raise dough. You don't raise money for real estate at real estate conferences unless you're trying to raise from capital raisers, right? If you're trying to personally attract LP capital, it's just not the place to do that.
It's really tough. Like I have that conversation with people really frequently. I'm like, okay, so you have your flights, your hotel, your conference fees. I'm like, if there's many better ways you can go spend your time. And also for me too, conferences, I leave there and I'm wiped. Like that is a major energy suck too. So you only lose days of productivity, recoup time, costs. Your opportunity cost is huge for conferences, especially if you have limited resources up front. Like you should get your first raise done, scraping together to get it done. Like get something done in progress. Your conference to capital raise ratio should not be overly high, right? Like get raises done, get deals done, find online education versus going to these things. But have an intent of what you want to get out of it too. If your goal is to go learn a certain tactic or skill and that conference provides that, great. If your goal is to go find capital and you're going to a conference that's focused on people who are also doing deals, well, look somewhere else.
Yeah, 100%. No, we're in total agreement on that one. I know we're coming up on our stop here and you got to bounce. So why don't you share where people can learn more about you? And obviously, talk about Fully Funded, talk about the community. You already briefly mentioned it a few moments ago, but dive deeper into that and share any other ways that folks can get in touch with you.
Yeah. So right now, in terms of what we're working on, it's really twofold. One is a company called TechFester. We're probably one of the largest owner operators of short-term rentals. So you go to our site, techfester.com. You'll see all of our properties there, beautifully done. Always looking for capital partners in that space too. So reach out to me on LinkedIn, super active there. Alternatively, I run a mastermind community all focused on people who raise capital. So whether you're a deal sponsor, an operator, whether you're a capital allocator like myself, or you're someone who wants to learn how to go raise capital, it's a great fit for you to go understand how to go raise more capital, meet capital partners if you're an operator. But really, I think a big thing too is just having people around you who are all focused in the same thing is hugely valuable. I know on my end, I would have paid a lot more than we're charging to go do so, to go avoid a couple of deals I did at first. I think just having people who have been there and done that is a huge, huge piece of it, especially in a very, very niche industry.
Yep, 100%. This has been great, man. Appreciate the time. And obviously, we're going to be staying in touch. But to everybody listening, go check out what Sam's got going on. If you're a capital raiser and you do want to raise money for, you're not specific to multifamily or an asset class and you're interested in short-term rentals, I haven't personally raised for TechFester, but I think I know like 10 people in my network that have worked with you and the folks at TechFester to raise for obviously the funds that you guys are doing. So big plug on my end for that as a strategy to at least start raising capital and start building your base. And I think it's a great way to do that in a low commitment way. And I know that that's something that you guys pride yourselves on: high return on raise, lower minimums, all that funner stuff. But in any event, links in the show notes for everybody that wants to go and check out everything Sam just mentioned. And appreciate you coming on, man.
Cool. Thanks again.